Welcome, real estate investors, to this comprehensive in-depth look at the 2026 U.S. housing market forecast, drawing from key insights by experts like Realtor.com's chief economist Danielle Hale and projections from Fannie Mae. Following a challenging period of high interest rates in 2024 and 2025, the overall market is now set for much-needed stabilization along with modest growth, which will create fresh opportunities while also presenting some new challenges for savvy investors. Realtor.com's chief economist Danielle Hale specifically predicts that median home prices will rise by 3.7% in 2025 to nearly $398,000, or precisely $397,600, as noted in their November 2024 forecast. Then moderate to 2 to 3% growth in 2026 as inventory conditions improve. Home sales are expected to rebound significantly, with Fannie Mae's December 2024 Economic and Housing Outlook forecasting 5.19 million existing home sales in 2026, marking a substantial increase from the 4.85 million projected for 2025 and previous lower years. Mortgage rates are projected to average between 6.2% and 6.4% throughout 2026, representing a welcome slight decrease from the 6.7% peaks experienced in 2024, according to detailed projections from the Mortgage Bankers Association, or MBA, and Fannie Mae. Inventory levels are anticipated to rise by 20 to 30% from the 2024 lows, potentially reaching as many as 1.5 million active listings by late 2026, which should help ease some of the persistent supply constraints without fully returning to pre-pandemic abundance. On a regional basis, Sunbelt markets such as Austin, where price growth is slowing to 1.5%, and Phoenix may experience further cooling due to overbuilding, whereas Midwest cities like Indianapolis and Cincinnati could see stronger 4 to 5% price appreciation. For those focused on rental property investments, national rents are expected to grow by 3.2% in 2026, according to Zillow forecast extensions, resulting in attractive cap rates of 5.5 to 6.5% in the top-performing markets nationwide. Multifamily investments continue to look strong, with vacancy rates holding steady at 6.8%, while single-family rentals will particularly benefit from robust demand as 34% of millennials reach their prime renting ages of 35 to 44 by 2026. That said, one notable challenge is the rising insurance costs, which have increased by 20% year over year, potentially pressuring the net operating income, or NOI, for many rental property owners across the country. House flippers should prepare for margins to compress to 10 to 12% ROI, driven by the modest 2 to 3% appreciation rates combined with elevated holding costs and an average of 45 days on market. Nevertheless, high-velocity markets like Atlanta still hold strong potential for 20% flip profits, though investors in cooling areas will face considerably higher risks and thinner margins. Opportunities in tax liens remain quite limited, as foreclosure starts are at historic lows of just 0.3% of mortgages, totaling around 150,000 nationwide in 2026, according to CoreLogic data. High-interest tax liens offering 8 to 18% returns can still be viable in distressed pockets like parts of Florida, but high redemption rates exceeding 90% often significantly reduce overall investor yields. Realtor.com's Danielle Hale warns of key risks, including persistent inflation or even a 30% probability of recession as estimated by JP Morgan, which could potentially cause home sales to drop by as much as 10%. On the brighter side, promising opportunities exist in build-to-rent communities with 50,000 units planned for 2026, alongside value-add rehab projects that can deliver solid returns. NAR's Lawrence Yin points out that the lock-in effect is easing, noting that 80% of homeowners currently holding sub-4% mortgage rates would consider selling if rates reach 6%, boosting inventory. Additional potential risks to watch include geopolitical tensions that could spike rates back to 7%, major policy changes following the 2024 election such as adjustments to tax deductions, and job growth slowing to just 100,000 per month. To effectively adapt, investors should shift toward cash flow-focused rentals rather than pure speculation and diversify into promising Midwest and South secondary markets for better stability. Also consider utilizing seller financing or HELIX with rates around 8.5%, while extending your hold periods to 5 to 7 years to capture improved long-term returns in this market. Make sure to leverage 1031 exchanges for optimal tax efficiency and closely monitor the projected Q1 2026 Fed rate cuts, with 2 to 3 anticipated at 25 basis points each to support the market. Overall, the 2026 housing market shapes up as a landscape of stabilization combined with strategic growth opportunities tailored for well-informed real estate investors. By thoroughly understanding these detailed forecasts and proactively adapting your investment strategies accordingly, you can successfully navigate and thrive in this evolving market environment. If you found this detailed video analysis valuable for your real estate investing decisions, please give it a like, share it with fellow investors, and subscribe for more expert insights and forecasts.